founder who is not self-aware generally tends to lead to bad startups.
You ask for money, you'll get advice. If you ask for advice, you'll get money twice.
You want to get as much traction as you possibly can without having to worry about funding.
You've done the research on the VCs, fill in the blanks, and this is how you put it.
If your market is interested in your solution, that to me is the biggest indicator that you're on the right path.
The greatest trick the VC devil ever pulled was making you think that startups that didn't raise funding and were successful didn't exist.
Pitch everybody. Just pitch everybody.
Hi everyone, I'm Micah McGuire, head of content here at GrowthMentor, and welcome to another episode of GrowthMentor Live. Today we are discussing the new rules of funding in 2024, and I am joined by Ari Benjuya, Sam Eisenberg, and Harry McLaughlin. So today we're going to have a really free-flowing session. It's going to be a lot of different questions on funding. If you have any questions, please go ahead and put those in the chat, and we will be working those in as Q&A as the panel goes on. So great to have everybody here. Mentors, it is fantastic to have you all here today as well.
Thank you.
Thank you.
Thanks a lot.
Alrighty, so we'll go ahead and kick it off with just a quick temperature check. How do you guys kind of feel about the funding environment right now? I guess, negative, positive, neutral, Harry, what do you think?
What I've seen and heard, it's booming. I think it's a fantastic time to raise capital, no matter what your company is. People are writing checks. They seem to have lots of dry powder. I think it's great.
Okay. Sam, Ari, any thoughts as well?
Absolutely, yes. So there's a lot of talk about, a funding downturn. We are seeing in many ways less capital deployed in different markets. But ultimately, there's still a tremendous amount of dry powder, especially in the US, but also abroad as well, that's ready to be deployed. So while there may be new norms in terms of how to raise and how to actually get that capital, but it is out there and available despite some common sentiments you may see.
Cool.
Ari?
Yeah, I never really care, to be honest. Like, for me, it's if you have a good company, you're going to get funding, right? So, clearly there was way more funding than there should have been during the pandemic with a lot of bad people getting funded, bad companies getting funded, let's say, right?
Okay.
Afterwards, it was a bit of a downturn and it seems to be turning back up again. But ultimately, if you're an entrepreneur, just build a good company and get funded, right? Like, I'm not so worried about market stuff than anything else, to be honest.
So, and I guess that kind of actually touches on our next question was, is there anything specific that you guys have seen in like the last year and a half that's kind of cemented that? And it sounds like this was a case of the VCs were maybe a little over-enthusiastic at a certain period of time. And basically now it's kind of pulling back a little bit, but it's still the same rules apply of build a good company and you'll be in good shape.
So as the pandemic started, I think all VCs backed off on funding for a while. And then they realized that they have to deploy all of their money really quickly because they have, deployment mandates. So basically, they spent 6 months not funding anyone, and then the rest of the time getting rid of their funding, basically. Mm-hmm. Afterwards, because of markets and this and that, I'm going to say bad VCs died, basically. They were not able to raise their next fund, so the amount of money was out. But the good VCs are still there, and they're still investing. So it's always cyclical, but it seems to be on the upswing after the low point at this point.
I think the good VCs got a little bit smarter too. I think they got burnt a lot. And so, like you said, the bad ones are out. The good ones have more of that capital to deploy, and the good ones are actually do due diligence. And so some of the dumb ideas and bad, startups aren't sucking up much of that capital that was out there. And so it's if you've got a good company, you're like Ari said, you're good chance you're going to get funding.
Mm-hmm.
Yeah, and I would say also just something that I saw that was interesting is we were working with a few of the bigger VCs who are actually raising capital from LPs like they do, and I noticed that during this process, one of the VCs we're working with significantly slashed the size of their fund, and I asked them candidly what led to that, and more than anything, I don't know if VCs are getting smarter or if VCs are getting more careful, but they're definitely being held accountable by their LPs. So based on that fact, they reduce the size of the fund with an intent to give out a little bit less capital, a little bit more carefully. So.
Okay. That makes perfect sense. And I guess I know this may sound like common sense at the same time, but I would love to get everybody's takes on this. What makes the difference between a good startup and a bad startup? So is there anything specific that you guys, say that whenever you see that, you're like, oh, that's not going to go well whenever they go for a funding round or they're going to end up burning out or something like that?
I mean, revenue helps. A lot of people don't. They try to push that off too late. I mean, if people are willing to pay for it, it's a good indication that you've got some level of product market fit. Okay. And that de-risks it for the investor, a lot usually.
Yeah. It's a combo, right? Like there's no startups. Every successful startup is the exception, right? With the idea that whatever, only 5% of these companies become unicorns. And so there's no
Right.
such thing. Like they're all the exception. But at an early stage, which is more where I look for the most part, right? It's do you have a sound solution to a problem? Right. I use this in mentorship sessions, and it's a terrible example, but it's like if your solution to climate change is covering the moon in cheese, like you're probably not going to get funding. Like that's a bad startup, right? Like that's not. There's no problem solution fit there, right?
Right.
The problem, the solution that you have has to actually solve the problem. Is number one. The founder has to be self-aware enough to realize what's going on. So a founder who is not self-aware generally tends to lead to bad startups, let's say, right? Even if they're able to get funding, like that self-awareness and self-reflection is something that's super important. So founder is important. The more self-aware the founder is, the more likely the deal is, or the solution is to solve the problem. And then the last thing is just market. Like there are some really good ideas out there that just are never going to be the billion-dollar company that VCs need them to be. I was talking to a VC earlier this week, and basically he said, "Oh, but that idea is not going to hit that 1% to like be able to create outsized returns." And it's like, look, as a founder, if you're going to get VC funding, yes, that's required. But as an entrepreneur, if you just want to start a good company, outsized returns is not necessarily the end goal, right? So just having an understanding of how big your potential market is and what kind of market you're trying to serve is super important.
Okay, great. You've actually got a couple of points I want to put a pin in and come back to, especially with that point about, outsized returns and entrepreneurs and what's your attitude there. But Sam, did you have anything to add on that, good versus bad point before I jump on to the self-awareness? Because I actually love that.
Absolutely. So first of all, I would want to make a distinction between a good startup and a startup that's likely to raise capital. Obviously, there's some overlap between the two, but the vast majority of companies don't successfully raise capital. I wouldn't necessarily hold that against them. When you're talking about the highest likelihood of raising capital, that's going to be first and foremost the team. Stronger team, especially at the early stage, that's who the investors are betting on, will make it much easier. In terms of a good startup, like Ari said, you don't want to be what they call at YC a SISP, a solution in search of a problem. There needs to be an actual painful problem being solved and a solution that's aiming to solve that problem. So to me, any startup that's actually solving a painful problem is a good startup.
Okay. All right, great. Ari brought up this point about self-awareness with founders and things like that, and that is actually something that I didn't even consider. So what would be your advice for founders just gaining that self-awareness? What can you do to kind of gut check yourself and make sure that you've not fallen in love with your idea and basically aren't seeing your blind spots?
I guess I'll take it as given I brought it up. I always say, as a founder, there's a really fine line between being like a really good founder and being like this delusional crazy person, right? Like you have this gigantic vision and it's really hard to understand whether you're the only one who believes in this idea or if you're actually crazy. Every rejection, every feedback that you get, it's a gut check, right? When a VC says, "I don't think your market's big enough," for example, which is generally a cop-out for "I don't want to invest in you." But when a VC says, "I don't think your market's big enough," take a look at the VC, take a look at what they say. If you hear this like 3 or 4 times, recalculate how you're doing your market. And if you don't think you're calculating your market size the right way, then go talk to somebody about what's the best way to, talk to somebody who's not necessarily going to invest about how would you, calculate this market size is number one. Every rejection is a gut checkpoint, basically, is really what it comes down to. And if that gut checkpoint is they didn't understand or, they're not part of my business model or I really believe this works, then if you're convicted or you have conviction in what you're doing, just keep going and, pray that you're on the right side of the line.
Yeah. And Harry, Sam, anything to add to that?
You kind of bring up a good point about conviction. Like crazy people do get funded. Right? Like they don't build great companies most of the time, but they do get funded. But how you can, to keep yourself in check is like, don't be shy of having those like hard conversations with VCs. And if you get a rejection, ask why. Don't let them go. Keep pestering to like find out the math around their decision, and get in their head on why they made that decision. And sometimes it's like your companies just like totally out of their realm. Didn't matter, but it's like you have those hard conversations enough like times, you're gonna start self-reflecting a little bit, and that can kind of like keep you in check.
And I think for me, where I actually, when I'm thinking about self-awareness for a founder, I want to be getting that feedback from the market, not from the VCs. So if I'm finding the target market's interested in my solution, they're interested in learning more about it, they're interested in staying in touch, they're willing to even put down money or sign some sort of letter of intent or agree to be a beta tester or whatever it's going to be, that to me is the best signal that you're onto something. Sometimes it takes VCs a little bit longer to catch on. Sometimes you need to get a little bit better at telling your story. But ultimately, if your market is interested in your solution, that to me is the biggest indicator that you're on the right path.
Yeah.
Okay. And I guess this kind of touches back on one of the points I wanted to loop back to, which is funding isn't for everyone. You know, you may have a problem that your total addressable market isn't just big enough or anything like that. I guess at what point is it worth making that decision? Do you sit there and look at the market signals and say, you know, hey, the market's going crazy over this, but I've been through, 10, 20, 30 rounds of trying to reach out to VCs and I keep getting no's? Is that the point that you kind of go, well, maybe I don't need to go the funding route? Is there a point that you reevaluate that?
Yeah, so I would actually look at that inversely. It's that the default should be to not go for funding. There are going to be rare exceptions where, you have some biotech or deep tech, space tech, I don't know, something that will require a huge amount of funding to get off the ground. Okay. But for most solutions, you want to get as much traction as you possibly can without having to worry about funding. First of all, that would allow you perhaps to, continue on that route and build a sustainable company without it, which is ideal for many founders, both from a business perspective and from a personal mental health perspective. And second of all, when you do want to raise, it'll make it easier to raise and allow you to raise at better terms. So getting as far as you can without having to raise is usually what I would recommend.
Okay.
And the exception is if you are going to raise, what is the reason you're going to, and what's the reason you're going to be telling investors why you need to raise? That's very important as well.
Yeah, like I don't want to say gone are the days of raising with a deck and an idea, but like the prototyping tools, like be able to build a bubble app that brings revenue. It's not the cleanest thing, but it shows your proof of concept, and it's like you can get so much further now with the tools that are available in like build and working towards to build your product and to find that and to like prove that your solution might work and get those traction points you need. Like it's never been, you can never get further than you can today with all of the tools available. And if that's with like no money too, with like zero capital. So because of that, it allows you to push off your search for capital till a later date, till you have some more of those traction points. And you don't want to like go raise, you don't want to give away a chunk of your company too early. Like get some value for you. Like you'll get killed on valuation, and they'll own something that they shouldn't. If you can push it off, like do it.
Yeah, for me, as a fan of the usual suspects, I tell people, the greatest trick the VC devil ever pulled was making you think that startups that didn't raise funding and were successful didn't exist. Right? It's not the case. I like Sam's idea of the default should be don't raise funding, because I kind of call it the philosophy of like enough. Right? It's like if you're a founder who has a team of 3 people and you're making $10 million a year, you may not be good enough for a startup. Your idea may not have a big enough market size for a VC, interestingly enough, right? They're always trying to hit that home run with the unicorn, right? Every single company has to have a clear path to be able to make, that $1 billion valuation.
Right.
And as a founder, look, it's like, I just want to make a couple million a year or whatever. I want to make $1 million a year. And that's enough for me because I have my life and I have my family and I have this and I have that. And it's, understand that building $1 billion company is a crazy endeavor. It's why there are a handful of people that have done it in the world. And it's probably less than 1% of the entire world population. Like it's insane to do it. It's hard to do. It's very difficult. It's unbelievably taxing. Is that what you want? Like if that's really what you want, then maybe you want to think about your idea in a different light. But if your idea is just to build a successful company, you don't need VC at all. You don't. And so understanding that and making the default, I don't want funding, is always going to be better. And just because you don't get funding doesn't mean you can't be like Canva and go and be $1 billion company anyway, without ever having to get, a dollar of cash.
So, and again, it sounds like it's coming back to that self-awareness of knowing what do you want out of business, because it sounds like if you are aiming for VC funding for the sake of VC funding, we kind of run into this growth at all cost mindset that I think ends up burning a lot of founders out, both cash-wise and mentally too. I think that kind of brings us to another question that, Ari, I think before the session started, we were kind of talking about finding out your why behind getting funding. And Sam kind of hit on this too with figuring out what you need the funding for. Can we kind of talk about that a little bit of like how you figure that out essentially? How do you sit down and say, okay, this is really why I need to do the funding. This is the barriers that are in my way. Is there any kind of analysis frameworks, or is it just literally sitting down and just thinking things through?
No, it's all about faster growth, right? So if you have a profitable company and you have $5,000 in surplus every single month, and you want to go and hire a salesperson, that salesperson may cost you all of that $5,000 a month, and now you no longer have that surplus, which means you don't have risk. Basically, you don't have the ability to take bigger risks. If you go and get funding, you can hire 2 salespeople at $5,000 a month, and one of them might not work out, and the other one's going to work out and stay with you, for example. But you won't lose 6 months trying to hire and fire and find the right person. So having 2 people will help you grow faster than having 1 salesperson, right? Or having 1 salesperson not churn out is going to make you grow faster. And so there's 2 different ways to kind of look at resources. And I think it was Mark Suster who wrote the article at the time, but it was 9 women can't make a baby in a month, right? There are some problems that resources cannot solve. Right? One of those problems is product market fit, or even your first customers, right? Like for the most part, having more money is not going to help you get to your first customer faster, right? It's not going to help you understand if you have product market fit. But once you have product market fit, having more resources is going to help you, as opposed to just blogging, right? You can hire someone to do blog and someone to do CPC and someone to do outreach and someone to do the sales and someone to manage the customer success all at the same time. And so you get VC money so that you can get to where you're trying to go in 3 months' time or 6 months' time or 1 year's time instead of 5 years of time. And so basically you're buying time with VC money. And again, it comes down to the question of self-awareness. Do I want to run that fast? Do I want to try to make 5 years of progress in 1 year? Am I going to be able to manage all of that chaos is a question you ask.
I think sometimes we come across as like, don't ever raise capital. That's not, yeah, there is a time and a place for it, right? Like, and like at the end of the day, money does solve a lot of problems, right? And it definitely solves a lot of time problems. Like you can get to where you want to go faster. It's going to come at like a cost. Like in the US, is there like a framework to do it? It's like if you are 100% confident that you can't, you're at, you've gone from 0 to 1, you're at 1 to 2, but you are 100% certain that you can't go from 2 to 3 in a reasonable time, where there's other pressures like competition maybe, well then, yeah, there actually is like a place for funding and you should be like looking for it, doing it properly.
Sam, anything to add there?
No, I think in general, Ari and Harry really covered it all, but ultimately you do want to tie the reason that you're raising to either a product or growth. So it's either going to be, my product has reached a certain level, it has a certain level of validation, and now in order for me to, actually put out the full version or the MVP or whatever stage you're up to, I'm going to need to raise capital to hire engineers. Or inversely, it could be, hey, we've already figured out how to acquire customers. We started acquiring customers, but in order to grow that, we need more capital, whether that's to, grow a sales team or tap into existing marketing channels, whatever it's going to be. So for the most part, your objective with the raise should be tied to product or growth or a combination of the 2.
Makes sense. Makes perfect sense. So I guess here, I think we've obviously already hinted at, if you're going 0 to 1, probably funding does not need to be the first thing on your mind. But if you've got an early stage founder that is going 0 to 1, and maybe they've decided they intend to get VC funding, they know probably not a good idea to do it now, but they eventually want to do funding. Where do they focus first?
What do you mean, where do you focus?
I guess if you're just getting started off, would you focus first on making sure your product market fit is strong, and then like from there, what's the chain of events? Is it, make sure you've got product market fit, then see what your total addressable market looks like, and kind of explore out from there? Is there a way to basically figure that out essentially?
So step 1 and step 2 are always have a product and have a customer. And interestingly enough, if you're solving a problem that is big enough, you can get the customer before you have the product. Like that's a thing. Yeah, because you can say, hey, Sam, I hear you have this giant problem. Would you pay me money up front to build it for you? But basically, that's what software companies do, right? Somebody comes to a software company and says, hey, I have this problem. Can you please build a software solution that solves my problem? You say, okay. And they give you money up front. You solve the problem, and they give you the rest of the money at that point. And then as a software company, you can look at that and say, hey, can I just make this for other people as well, and just kind of white label that out to be my own product at that point.
Right.
And so you can get the customer first. It is possible. It's not normal, but it's possible to do. So you need a product that solves some problem and a customer that is paying for that product. And if you have those 2 things, it's going to be a lot easier to get funding. If you don't have those 2 things and you're getting funding based on an idea and a deck, your idea better be pretty different and you better be pretty different. Right? So you have to be super convincing to the people that you're talking to. That's why they always say friends and family, right? Because your parents are most likely to invest in your crazy idea. But you need to be the one who's convincing the investor that you're worth investing in, is kind of how it comes down to. So I would say those are the first 2 steps, and then it goes from there to product market fit and finding a repeatable sales process.
If we're talking the ideal situation, if we're saying, what do these founders need to have together before going in, if they are going to increase their chances of getting funded?
I mean, sorry, I'm jumping in again, but it's like there are accelerators now in the Silicon Valley that just invest in the person. It's like, you don't need to have an idea. You don't need to have a team. You don't need to have a market. You don't need, I just like you as a person and you want to build a startup. So here's $100,000 to take a year and figure out what it is that you want to do. There is no prerequisite. Anything that you do along the line, the product, the customer, the traction, the product market fit, the scalable, repeatable processes, it just makes it easier to get funding. But funding is not, it's very different from growth, right? In growth and marketing, we always talk about, it's a numbers game, right? How many people did you get in front of? How many people converted? How many people did you get in front of? How many people converted? What is your conversion rate? Those kinds of things. In funding, it's greater than zero. If one person invests in you, then you have done a successful funding round. Now go build whatever it is that you
Yeah, there is no minimum, right? Like, people get funding on ideas all the time. Like, you have to be able to get it, right? Like, no one's just gonna walk up and hand you the check. You're gonna need your pitch refined. You're gonna need, like, the kind of, you're gonna have your ability to convince people to give you that check basically has to be refined. And there's a lot of little things that you can do along the way to help improve that. One is just pitching your heart out to everybody who's going to listen. Your pitch is going to get refined, more and more refined. In your initial pitches, you can do like little tricks that just help people believe in your idea, and that might be talking in just like absurd confidence, right? Like, some of the best pitch artists I've ever met, when you go and talk to someone, you're pitching someone, it's natural human nature to be like, well, I believe that we're going to be able to do this by this day, or like roughly this date, as long as like no other things come in like front of us. And the guys who are just like the pitch artists are like, no, we're going to be launching on October 32nd or 31st at like 2 p.m. and nothing is going to change that. And so they're just talking in absolute certainty. But it's circling back. It's like, you got to work on yourself. That's the number one thing you gotta work on, and that's probably the thing that is going to lead to the best early success.
Sam, anything to tack on there? Or?
Yeah, I mean, there's no minimum to raise. It depends who you are. It depends what you're trying to raise, who you're trying to raise from. There are so many different rules. Like, if we're talking strictly venture capital, then yeah, some of the rules are pretty well known. Some of what they're looking for is pretty well known. Obviously, every investor has their own thesis, but venture capital or even angels are one of many, many, many funding sources. You can raise money, there's so many different ways. I don't even want to start getting into it, but you can raise with anything. As we said earlier, like, it's more important to have a viable startup, a startup that's actually solving a problem, than it is to have a startup that's primed to raise.
Raising is not the end game, right? Building the company is the end game. So as long as you're convinced that you can build the company, raising funding is just a tool. And I think as an entrepreneur, always remember that the VCs are there to serve you, not the other way around.
That's a great point, to keep focus on the goal, that it's building the company. That's actually a really excellent way to look at it, I think. So I do want to actually jump to pitching, just because we've touched on that. Harry, you touched on that there. As far as pitches are going right now, is there something specific that's working in pitches? Is there something specific that's working in pitch decks, for example? What have you guys seen that you've gone, oh, wow, that's really works well?
Flying works great. No, don't do that. It'll get sussed out.
You'll get the second meeting, but not beyond that.
Yeah, some people do that, but no. Like, so a lot of people actually will, almost like lie in their pitch decks, lie in their metrics, and like a sophisticated investor is going to find that in due diligence, and you'll be like blackballed. They talk. You gotta be honest, and you gotta be realistic. You've got to be direct and like not shy. Like, VCs will, like, if you reach out to them, even cold, if you do it properly, they will put you in their funnel, and they'll give you like a chance a lot of the time. The big one is like just pitching like to often the right audience is super, super important. You don't want to shy away from pitching. Even if you're pitching to the wrong person, they're going to give you probably some valuable feedback. They might likely give you a rejection. It'll give you the ability to refine your pitch and just get better and better and better and smoother at it. And then you can, when they do get the rejection because it was just like the wrong audience, you can go back and be like, hey, I understand like you're a Series A investor and I'm like, pre-seed, but who do you think in your network I should be, talking to and get those introductions? Because like introductions into the VC to like appropriate people is valuable. I would say that like with all of the capital I've raised over the years, I would say over 50% of it came from the introduction from the VC, like from the person that I was originally pitching. into their buddy that was the appropriate person. So that's the big one. I can tell you things that don't work. There's a lot.
Go ahead. I think this is a great way for people to hear, what works, what doesn't.
For sure. So things that don't work is cold reaching people and just dropping decks on LinkedIn. I think that well got poisoned with all of the automation. I might have helped to kill it actually. Back in the day, but feeling generally if you can get the introduction, do that. If you have to do cold, do email. If you have to do cold email, don't use an HT like a MailChimp or something like that. Actually sit down and write them a personalized email and structure it in a way that is personal. You're mentioning their funding, you're mentioning them by name, you're mentioning the area that they've invested, show you that you've done a little bit of research, visit their website. There's little ways that you can slightly automate about that, but then your whole goal of those those outreaches is I just need him to say, okay, I'll give you 15 minutes of your time to get the pitch, and make that the goal. You're not going to close an investment. You're not going to close a penny through just an email, right? They have to get sold on you at the end of the day. I've seen fantastic cold email strategies that actually work, but they have to be done well.
So it kind of sounds like also keeping in mind that the goal is not the funding on that first email. The goal is to just even secure a meeting.
Get them excited, give them enough to get them excited enough that they want to have a chat with you, right? Because there's going to be regardless, there's going to be a due diligence process that's going to last a long time before anybody gets actually writes you a check. And so, typically, especially for larger checks, for the pre-seed checks, it might be one pitch, but you still need to. They're going to want to know who they're investing in more than anything, and you got to be able to get them to that point.
Interest is important. Cold calling at some point might become inevitable just because you may not know enough people. I saw a question in the chat and I'll just kind of jump into it, Micah, if that's cool with you, which is how do you even get in front of VCs? It's you got to start funding before you're funding, right? If you have a startup idea, it's go to, entrepreneurship events in your area, sign up to online, meetups, if they exist. You have to try to build a network of people who are willing to listen to you about your idea and then like you enough to make introductions. And as time goes on, you're just going to be in that network of space enough that you're going to get introductions to some VCs. You will never get introductions to all VCs because nobody should know all VCs. You just shouldn't, right? So eventually, cold calling is a thing. This was a post that I saw going around on LinkedIn that I then added to, but here's a little template that I put into the chat in terms of how you should cold call to VC. Right? Your fund previously invested in X company, which means that you have a thesis that focuses on these kinds of businesses. Well, I'm that kind of business. Here's what I've achieved. Here's who I are. Here's what I'm raising. Are you interested? Let's chat. Super basic, to the point. And you've done the research on the VC. You're writing it specifically to that person. Just fill in the blanks. And this is how you cold call. It's just how it works. It shows that you know who they are. You know what kind of stages they invest in. You know what kind of ideas they invest in. They've invested maybe not in a similar, you don't want a competitor, right? But a similar space or similar field, whether it's B2B SaaS or whether it's a B2C mobile application or what have you. Having people who have invested in that space enough is where you want.
I think the only wrong, this is actually mimics a lot of the templates that I've used in the past. And I also want to say there's also almost, there's certainly no wrong way or bad ways to do it, but you want to do it regardless. A lot of people are too shy. They're oh, I reached out to 10 investors and I didn't get any responses. Don't stop, bud. This is going to be your life for the next 3 months. So that should be 10 an hour. And eventually you'll start finding the script that works and finding, the talking points that actually get you the interest from the investors. It's regardless, don't stop, even if it's not the right person. Try to send it, get it out to them, but make it personal. It's a lot of time. It's a grind. It's a terrible, terrible grind. I remember when we were raising capital for a startup I was with a number of years ago called Planswell. It took 3 of us to raise our first $1 million. It took 3 of us doing nonstop pitches, 8 hours a day for probably 4 to 6 weeks before we got our first check. Goodness. And then we got a little bit better every time. We started knowing the script. We started knowing, building up our passion. And it was so bad that our CEO at one point, he would go home at the end of the day and we'd be talking to him. He couldn't even talk. He was just like hoarse. It was rough. But we're all like first time founders, right? We hadn't done this before. And so we had to like learn that the hard way. And eventually we got it. And then it was just almost mechanical. It was like, we know that if you start hitting like a ratio, it's like, you know what, if we do like 30 more pitches, we're going to get X more dollars. And we just ground it out until we got it. And then after that, you're like, oh, now I'm an expert. Now I can just go raise capital whenever I want, which is probably false.
So it truly sounds like it's ultimately a volume game and also, a certain amount of experimentation, which I think people kind of see to an extent with outbound, but maybe haven't thought about with outreach for funding.
Yeah, the volume decreases depending on how good your company is, right? Which is why the weird part about VC is that VC will always say, get in, make your pitch, get your money, and get out, right? If you could raise in a week, that's time your 6 to 8 weeks of pitching 8 hours a day is a month and a half that you didn't spend building a company, right? And that's why VC is so awkward, because you spend all this time not building a company in theory, right? Like I said, that's why as you level up past all those different things, as you get more traction, as you get more customers, as you get more product market fit, it becomes easier and easier and easier. The earlier stage that you are in the process, more likely, the more volume you have to have. I posted on LinkedIn a while ago about like a company that had raised its Series A and they raised it in like a week, but they said what you don't see is that we raised our pre-seed over the course of a year and a half, right? We would just kind of pitch a founder and it wouldn't work and we'd go build the company some more and then we pitch again and it wouldn't work and we go, And so you can either blitz it like Harry and his team did, or you can try to do it over a series of time and over a long period of time. Another kind of quick note in terms of how to get in front of VCs, look at their portfolio companies and see if you have any CEOs from their portfolio companies that are within your network as well. And then try to, reach out to them for mentorship on your product and those kinds of
other strategies are around getting in front of VCs. Like, don't think VCs are the only people that are investing, right? Like, certainly for later stages and stuff. Yeah, like you go to the professional investors, but like when you're like pretty early stage, one of the best strategies for collecting checks is looking for like people who know the industry really well and made a lot of money in it, basically, right? So like we were doing a fintech startup, and so the startup I was talking about earlier, a lot of our first checks were basically reaching out to like wealthy bankers and saying, hey, we're solving this huge problem in the industry. It was an automated financial planning company. It's like no one's getting good advice, and we know that. And we actually approached them with the strategy of not by asking for money. So what we did, there's a good quote from Pitbull, the rapper. It's like, if you ask for money, you'll get advice. If you ask for advice, you'll get money twice. And we use that strategy to like huge successes. We'd be like, hey, we want your thoughts on what we're building. We'd love to problem interview and stuff. And it gives you information that you can then use to pitch them later, right? And B, you actually get a lot of really good advice. And if they really like and see value in the product that you're creating, so often they're going to be one of those like early pre-stage investors. So it's a great strategy to use for that like really early stage.
Yeah. And that's actually a really interesting one that I guess, how would you go about breaking down who to talk to, like based on your space? Because I think fintech, that's, a really interesting one, that bankers were kind of a natural point there for you guys to talk to. Was there a way that you guys said, we're going to speak to bankers, we're going to speak to financial planners, I guess? Does anybody have any thoughts on how you would go about figuring out what those, I guess you would say, non-investor targets might be?
I think the people that understand the problem you're trying to solve is the best demographic to look for. So I think someone in the chat said everyone's raising capital for like AI, and you can't like every VC is an AI VC. And it's like, well, if you're like early stage, like don't get fooled. Like there's a lot of people that have made a lot of money in manufacturing, and if your like problem speaks to them, they can be a potential investor for you. They don't have to be like professional VC.
Absolutely. And I think that if you're building a startup, you should have a good sense of the industry you're working in. You should know who's made money in that industry, whose this problem is impacting most deeply. We have a legal tech startup that we're working with now, and their first funding they raised from a large law firm, meaning they went to them and said, hey, we want to build this. We're lawyers. We're aware of this issue. And they raised, a very substantial sum of money because it was a very big problem. This law firm was willing to invest in it. So they gave them that initial check. And then from there, they said, okay, now you need to go raise from other investors as well.
Yeah, but that's also a super good signal for other investors. It's, hey, look, one of my customers thinks this is such a huge problem that they invested in me, right? Mm-hmm. And now you have your first check in, which is down the traction line in a sense, right? Having an investment from one of your customers is a huge green flag, right, for investors. They still might not invest. They probably still won't invest, right? But it's still, it's not a bad thing to have. I sold them the product and now I sold them the company, right? It's pretty good.
When you're working on more formal rounds too, it's like for them it's a race to be second. It's super annoying. Like, but as soon as you get that first like decent like lead investor in, it's just done. Like your round's closed as soon as you get the first one. A lot of the time, but especially if they're reputable. But it's a grind getting that first one over the finish line for sure. You have to be so persistent. Like that's the other thing that I think people do is like they'll have a good conversation with a VC and then they'll wait for the VC to get back to them. No, do not give them any breathing room. Like, you know, you're on their back until they like force you off of it or write you a check.
And Ari, Harry, the companies you guys mentioned, or excuse me, Sam, companies you guys mentioned were kind of on the B2B side. I guess, does anybody have any takes on if this kind of changes, if you're more focused on B2C? Is there a way that you need to change your strategy there?
Yeah. So actually an example, another company who I recently helped bridge rent, they were a consumer app. They tried very hard to raise venture capital, angels, everything fell flat. So they went out and actually did a crowdfund and a very successful one. So that's an option they have with consumers. I mean, that's again one of many options. But yeah, if someone is, if you understand your industry, you understand who may be impacted by this problem, who may be interested in investing in this solution, and there's 100 other options besides VC.
Yeah, I mean, that's what I raised for a B2C app, right? I guess we were the B, and it was a consumer app that was a TikTok phenomenon for a small period of time, but the process was the same. Just who you focus on differs, right? A lot more VCs have invested in a B2B SaaS company than have invested in like a viral mobile application company. But there are companies who specialize in that, and they'll ask the right questions and they'll know the right, levers to understand whether or not you can take what you want to take to where you want to take it. Just make sure you're in front of the right person, right? I worked with an agri-tech business with a fantastic founder and a fantastic product. And one of the VCs kind of feedback to us was, I think he's a great founder. I think it's a great product. I understand nothing about this space and I'm not going to take the time to learn. So he should go get funding from someone else, right? Because it's just not worth his opportunity cost of understanding, what are the ins and outs of knowing that business. It's super important to go to the right VC.
So making sure that you have alignment between what your company does and basically what the VC understands, essentially.
One thing and this might be a little off topic, but I think it's really important to say regardless, especially for early stage, certainly for first time founders and stuff, is that if anyone comes to you promising that they can raise you capital for you, they are going to steal your money. Like it just is a guarantee. Like they're going to be like, yeah, like I've done right. They'll have slick looking websites. These people are scammers and they're good at it. And they'll have like testimonials that's like from actual companies and things like that. And so often, especially on these super early stage founders, because people like their lives are invested in this. It's like life or death for them, right? Like, so they know that, and they'll be like, hey, for $20K, I'll do what I've done 100 times before, and I'll raise you your first $1 million. It's like that. The second you write that check, it's the last time you're ever going to hear from them, and they will disappear with your money. So it's like, a warning of what not to do is like, just don't fall for that. And I actually know people who have, like really smart people who have, and it's tough.
Yeah, that sounds really rough. I guess any other advice on what not to do?
So actually, I actually haven't seen that before, which I've seen plenty of scams related to fundraising and promises and all that, but I haven't seen to that level of, hey, well, give us $20K, we'll raise for you. So I'm happy I haven't been exposed to that. But ultimately, on the inverse, I do get pitched by a lot of people, hey, could you go out and help me raise my round? Could you go pitch for me? And I said, no, because I'm not you. Your investors want to invest in you. And if you can't pitch, if you can't sell, then they don't want to invest in your company either. So this is something that I've had twice now in the past month, where companies have come to me literally with offers for me to raise for them. And it just won't work. And, whether or not we like it, it's not about being flawless. It's not about being like, Toastmaster-esque perfect pitch. But you do need to be able to speak to an audience. You need to be able to pitch investors. You need to be able to pitch customers. You need to be able to pitch future employees. There's a lot of different things you'll need to do. So, get out of your comfort zone. Do what you can. You can practice a lot in front of a computer. There are great tools to help you get, improve anything that you may be uncomfortable with in terms of your pace or anything like that. And then after that, start pitching people who you're not scared of, right? Obviously, it could be random strangers. It can be people you meet through GrowthMentor or any other community. Hey, can I get 10 minutes of your time to pitch you? You can do it via video to make it really easy for them. If you're at that comfort level, you will need to be doing that pitching yourself. So don't hire anyone to raise for you. Don't hire anyone to pitch for you. And be very wary of people who offer checks way too fast.
Yeah, I've seen it work with a very few people, right? But for the most part, they're like 95 to 99% scammers. Basically, you should be doing the fundraising yourself. I've seen, like I said, I've seen one okay middleman in my life of doing this whole thing, and I've been here for a long time. So
Was that later stage, like investment bankers, or?
So generally, no. So generally, it was he only worked with founders that really needed the introductions, basically. So he makes the introductions, and then they make the pitch, right? So he actually had, it's a long kind of topic, right? But the middleman is never a good thing because VCs don't like middlemen because that means, like Sam said, you can't get in front of your own customers, you can't get in front of your own VCs or what have you. Having a middleman who is respected by VCs is really hard to do, and figuring out which ones are and which ones aren't is hard to do. Use reference check there, get an idea of which VCs they know there. For the most part. And in general, the people who you will want to work with are going to ask for a success fee and not some sort of retainer. And if they are going to ask for the retainer, it's not going to be an absorbent amount of money. Maybe it's a couple $1,000s a month, maybe, right? And they're going to say, if we can't raise in 4 months, then you're not going to pay me this money anymore, right? Where they're making outsized returns on the investment itself. So, again, everything's an exception. I've seen it work, but it is hard to do.
Mm-hmm. Well, it sounds like to me maybe we need to have a mentee pitch practice group, perhaps, for everyone to kind of refine their pitches and kind of learn those skills, because it sounds like a lot of this does come down to being realistic with your idea, of course. But it sounds like more than anything, it's basically self-development for the founder. I mean, you have to know who you are, what you want, and what you believe in, essentially.
So it is. Every rejection is a gut check. Right? It's the same idea.
All right. So we have a really good question from one of our audience members, which is there a difference between a startup that is seeking funding with one founder or multiple founders? Do VCs prefer to have a multi-founding team, or is it just totally dependent on, hey, if you've got all the skills, let's say you're a jack of all trades that can do it. I know probably no one can do it end to end perfectly, but if you can sit there and say, hey, I can do the development and I can do the marketing and I can handle the product prioritization, does that change the way VCs look at it essentially?
So, I mean, obviously they look at you differently, right? And there are plenty of accelerators and other, even YC where they say they take single founders. It's quite difficult to get accepted as a single founder. Some people are saying that may change in the age of AI where there's even more tools available to help you. Single founder doesn't mean they're going to be doing the entire everything top to bottom, right? Ultimately, you're hiring employees as well. And you can also leave room for a co-founder, right? A co-founder doesn't necessarily mean they're there on day one. You can add a co-founder a little bit later. It definitely will make things more difficult. There's no way to deny that. And what I'd say is it's going to make it more challenging for you. It will not make it impossible. And you do want to be prepared to answer the question of, who are you going to add to your team that'll help overcome that? What are you considering adding a co-founder? What might that co-founder look like? Mm-hmm. So I would say that you want to kind of prepare the objections and questions that you can anticipate ahead of time so that you can answer them well once you do reach, investors or accelerators that are inevitably going to ask about that.
When an investor looking at you, they're going to be looking at the quality of the team. That's probably especially early stage, just the number one thing. And so if you're a solo founder, and you're not an absolute rock star, it's going to be a little harder for sure. You want to fill your team with rock stars. But at the same time, I've seen solo founder teams get funded, but the quality that they had was that founder was just off the charts, right? And it was incredible. But it's also don't take other, I don't want to swear, but crappy co-founders just so that you have a founding team. The people that you add on that founding team also have to be equally awesome and fill in the gaps that you might have. Don't just take a co-founder because you think it'll make your capital raising easier. It'll actually make it harder.
I think there's two things to understand why VCs don't want to invest in founders or solo founders, right? It's number one, overall quality of team, There is such a thing as like 1+1 makes 3 or 1+1 makes 5 if you can find the right partner. And then number two, what happens if you get sick or hit by a bus or have a serious injury? There's nobody who can take the flag and kind of keep it moving down the road while you're out, unless you've built this incredible team. But if that incredible team is a salary-based team, right? I don't care how much salary you give. If somebody doesn't have a significant equity or significant stake in that company moving forward, they're always going to view themselves as an employee and not as an owner of the company. And it's really, really hard to find people who see themselves as an owner of a company without any ownership stake or without significant ownership stake that is just making money. They exist. They are, more rare than unicorns, right? Ultimately, there is operational risk for a VC to invest in a solo founder, because if something happens to the solo founder, all of that money is gone. And so that's where the problem comes in. But like Harry said, don't find a founder just to say that you have a founder, because most companies fail because the founders can't get along because they weren't dating long enough before they got married. Basically, you're going to spend more time with this person than you will your significant other. You're going to spend more time. You see different things, and so finding someone who's also passionate about solving your problem is important, or at least someone who's passionate about solving a problem, right? And is excited to work with you because you're a rockstar founder is important. And so, give them significant stake. It's important don't give your co-founder 10% stake in your company. It's not going to be exciting for them. They're going to feel like an employee.
And I guess as well, this, maybe is a question that has an easy answer here. I'm not sure. But basically, is there a way to decide, hey, I actually need a co-founder on this? Let's say we have somebody that's thinking they can do this as a solo founder, and they're trying to decide, do I actually need a co-founder or do I actually need team members? Is there a way to make that decision, essentially? Is there a way to sit here and say, it's worth having a co-founder on that's going to have significant stake in this company? It's worth the, essentially equity risk, I suppose, that I need to have them on as co-founder, not as a team member.
That's a quote. If you want to go fast, go alone. If you want to go far, go together. Like having a bunch, yes, if it's just you, you can make decisions quickly and you don't have to worry about rallying other co-founders and stuff like that. But you want motivated people that will not work for necessarily money, right? It's great to have a team of people that are all working together and bringing their own experiences and willing to step in when there's when someone's sick and things like that, and really able to self-support. If you can have that, that's an awesome thing to have. You want to go for that.
Being a founder is lonely and it's hard. It's unbelievably, difficult. And every single question you have, you're going to want to ask somebody and double check. It's even to the point of hey, is this the right mail to write to the VC? Am I doing this the right way? Having somebody whose opinion you trust on the other side of that thing, not having ChatGPT give you its, inane brainstorm answers back, but having a real person with insights and experiences telling you, hey, I think this email should be changed because, or I think our business model should be changed because. There's enough questions that you're going to be asking yourself that you want to have somebody who's invested that you can bounce ideas off of. And that doesn't even begin to start talking about the emotional task that is being a founder. The emotional task of pitching VCs for 6 weeks, 8 hours a day. When you go home, you want to talk to your, co-founders, but dude, that was brutal, right? That was brutal. And I got rejected for 6 weeks, right? It's hard to get. And then at the very least, you have somebody behind you being it's okay. We're on the right track. We're learning. Let's go, right? And some days you're down and they're up, and some days they're up and you're down, and whatever it is. So there are a lot of benefits to having a co-founder. There are a lot of negatives to having the wrong co-founder. And I would say having the wrong co-founder is more detrimental than being a solo founder. But being a solo founder is incredibly difficult because startups, whether you're going for the unicorn big startup or whether you're just starting your own company, they're hard and they're tiring. And the worst thing that can happen within that process is also that you feel like you're on your own and nobody's.
It is kind of like a marriage, right? A lot of those same qualities that you're looking for in a co-founder is is this person going to basically sleep on my couch for a week while we grind out some, solution? Is this person, when things get tough, are they still going to be around? Because things are going to get tough, right? So those qualities are super important. You got to be on the same page.
All right. Well, I think that probably gets us wrapped up. I do just want to touch on one more question. I guess what would be just your number one takeaway for founders that are looking at investment? If we just had to have the quick hit, what's the best advice, you could give them if they're looking at, let's say, up to Series A, so maybe pre-seed or seed, what would you say, they should keep in mind?
I'm going to go back to, the end goal is building the company, right? Funding is a tool, the same way that ChatGPT is a tool, the same way that hiring a team member is a tool, right? Ultimately, funding is not the end goal, right? The end goal is to build a company. So if you think that you need to get funding to build the company, like check again and then check again and then check again, because that process is taxing and grueling, and they're also a owner of your company, right? So it's like finding a co-founder, because now you're going to have somebody who's checking in with you every 6 weeks being like, hey, did you hit your numbers? And the answer is normally no, even for the best startups. And then, so why did you hit your numbers, right? And maybe there's good reasons and maybe there's not good reasons, but is this the person that you want checking in on you, like a parent almost, right? Every 6 weeks. So just remember why you're getting the funding, and make sure you really need it before you get for it.
And don't be shy. It's like that's often my big one, is just like talk to everybody, pitch everybody. Like, like if you're in the capital raise, just like, get out there, build your confidence, work on yourself, like never stop telling your story. You're going to get feedback on your product. You're going to get pitching advice. You're going to refine it. Don't reserve it for one shot. Like just pitch everybody.
I agree with everything that was said. And I would say ultimately, like we're saying, an intense focus on acquiring customers, intense focus on taking care of your customers, on everything you need to do to actually build a sustainable company. At the same time, if you do know a raise is a reality, I would say that it is important to recognize that it takes a lot of time and a lot of effort, like we keep reiterating. And ultimately, don't wait for the last minute. You should be well aware of your books and well aware of the direction, and start planning your raise at least 6 months out if that's what you're going to need to be doing. So yes, focus on the customers, focus on the company, but if it's in the back of your mind, start planning, strategizing, and everything else you need to do.
Perfect. All right, so just for the audience's sake, is there anywhere to connect with you guys? Any projects that they need to check out? Anything like that? Just to wrap up, where should people be looking to connect with you guys?
GrowthMentor. Just reach out there. That's the big one. If you're still on it, awesome. Otherwise, you can track us down.
I agree. If you want my advice on a pitch deck, sign up for GrowthMentor. If you just want to see what I talk about online, I'm on LinkedIn, and you can talk to me anytime. But I don't have time for mentorship outside of organizations that I mentor for, and GrowthMentor is that. So that would be the best place.
All right, all. Well, that wraps us up for this session. Thank you all so much, and have a great rest of your day.